As we enter the months of June and July, we also enter the tax filing season, as 31st of July is the due date of filing tax returns for most taxpayers. Many taxpayers are often confused for tax provisions applicable to them and with regard to how can they plan their taxes effectively. In today's video, I'll cover two most important aspects. Number one, who is required to file a tax return in India? And number two, what are the most simplest tax planning techniques that everyone can plan? Let us begin with the first question. Who is required to file a tax return in India? Income tax return is required to file in India. Number one, if you have got Indian incomes which are exceeding the basic exemption limit which is prescribed under the income tax law, which is 4 lakhs of rupees for financial year 25-26, which ended on 31st of March 2026. Number two, if you have got any kind of tax refunds which are due on account of taxes which have been withholded by way of TDS, tax deducted at source, and if you want to claim refund of those, even if your income is not exceeding basic exemption limit, you have to file a return to claim the refund of those taxes. Number three, if you have got any kind of losses by way of sale of any assets, and if you intend to carry it forward to set it off against future gains by way of sale of any assets in future, you have to file your income tax return to make you eligible to set it off to reduce your tax liability in the future years. And number four, when you have got substantial financial activity in India, in case of depositing funds in your bank account or withdrawal of funds or in engaging in some kind of a business or activity which involves a large amount of financial transactions, the rates and the amounts which are prescribed in the law, then you have to file income tax return. Apart from all these conditions, you may choose to avoid filing a return if there is no benefit or mandatory requirement of doing so. Let us now understand as to what are the most common tax planning techniques that practically every taxpayer can use to optimize their tax liability in India. Number one, creation of a HUF. HUF is a Hindu undivided family which is created on the marriage of any Hindu male, and it has a separate identity of its own under the Indian income tax law. Since it is an independent identity under the Indian income tax law, it can have its own bank account, obtain a PAN on its own, and also have its own independent passive incomes. These incomes could arise out of rental, interest, dividend, or even capital gains. What the advantage of doing this is that there could be an income which can be divided within the family and passed over to the HUF to take advantage of the basic exemption limit which is available to every person, and also to tax those incomes at lower rates if the family members are having other incomes which are much higher in the tax brackets. This helps in reducing the overall family tax liability. The second tax planning technique which I would suggest is dividing the tax liability and the incomes across the entire family. Once the investments and all the avenues which are generating incomes are spread across all the family members, then every individual can optimize the tax liability, since there is a rebate which is available up to 12 lakhs of rupees of income to every resident individual. Meaning, if there is a resident individual in India who is not having incomes more than 12 lakhs of rupees, that person does not have to pay any tax. Even if the income is greater than that, by dividing and spreading the income across the family members, the overall tax liability is reduced because the rates of tax are progressive in nature. So rather than one person paying high taxes and entering into a highest tax bracket of 30% and above, it is better to shift the incomes across the family members and divide the overall family tax liability, which is why as a family the amount of taxation is reduced significantly. This can happen by dividing the investments which are done, which generate the incomes within the members of the family. The third and the most simplest technique is by comparing between the old and the new regime of taxation while filing the tax returns. Today in India, taxpayers have an option to select which regime is beneficial to them and can accordingly pay the taxes depending upon whatever is the tax liability arising out of that particular regime. There are several deductions, tax exemptions which are available in the old regime today, which could make it beneficial for the taxpayer, while the new regime does not have any major kind of deductions or exemption but has got lower rates of tax. By deciding as to which is the beneficial regime out of the two, a taxpayer can significantly save on the taxes, even though new regime would be beneficial to most taxpayers in our accordance as of now. By utilizing these simple techniques, you can reduce your tax liability to a very significant extent. Taxation is a subjective matter and every person's scenario could be different. So, it may not be possible to have a one-size-fits-all approach for entire tax planning. In this scenario, it is ideal to consult a professional who is expert in taxation laws to guide and navigate you further. Reach out to us and follow us for more updates from the world of finance and taxation.